Rule number 32, sub number 4, valuation rules. In the case of services of life insurance company, I am referring here, or any insurance company which offers the life insurance, not only the LIC, not only the ICICI, whatever may be the what we can call the insurance company which is authorized from the IRDA, Insurance Services Regulatory Authority of India, where they used to collect the premium. Premium only covering the risk, only the risk means what? X paying the life insurance premium for 20 years. Anything has happened in between to the life of Mr. X, compensation will be given to his legal heirs. Nothing has happened, 20 years are completed. Throughout the 20 years, Mr. X paid the premium only to cover the risk. At the end of the 20th year, insurance company will say, Tata, bye bye. That's all, nothing else. Because nothing has happened to Mr. X's life during the insurance coverage, therefore, nothing is given to X as a compensation. That risk cover premium, the entire premium will attract GST 18%. 18% on the gross premium. If the premium covers risk plus saving, what do you mean by saving? Mr. X undertaken a policy covering the risk plus saving and paying the premium for 20 years. In between of the policy period, X, for example, met with accident, he passed away. Compensation given to his legal heirs. No sir, Mr. X is nothing happened to him throughout the policy period 20 years. He paid the premium and is very healthy with Almighty at the end of the 20th year also, at the time of maturity. At the time of maturity, some amount saved by insurance company is throughout policy period of 20 years and will be given to as his savings to Mr. policyholder. That time for him, that premium saved amount is coming to him at the end, a bulk amount, highly helpful at the age of 60 years, 70 years, 75 years. So it's called saving. Generally, risk plus saving premium value higher than the risk only cover premiums. Now coming to the point of valuation with regard to risk plus savings. In the given case, if the policy says that 80% will be refundable at the end of the maturity, like that insurance company very clearly intimated to policyholder, whatever premium you are paying, 80% of that 100% assured we will return back to you at the end of the policy period or at the maturity of the policy period. That means what? That 80% none other than refundable deposit. Referring section 2, subsection 31 of the CGST, which talks about consideration. Consideration when it comes into picture does not include refundable deposit. This point, if you remember, I already referred in the definitions of the GST, where consideration as referred under section 2 subsection 31 of the CGST, consideration does not include subsidy from the government, does not include refundable deposit. Therefore, at the time of collecting the premium, what is the taxable value means premium value minus the value of refundable deposit. To deduct that, balance only taxable premium in the hands of the insurance company. This is what I referred here. Gross premium less savings, balance is the taxable supply to pay the GST. There are some insurance companies, some insurance policies where it is not possible to inform exactly what is the returnable refundable deposit at the end of the maturity. Definitely will give some amount as refundable deposit. It may be 80% or less than 80% or more than 80%, because insurance companies nowadays permitted to invest the premium amount what they collected, allowed to invest in the equity shares also. You are aware of that. LIC company nowadays, it came to newspaper and all the media. LIC, their investment in the Adani group of companies, so much of money like that we come across the news. So insurance companies now permitted to invest the premium amount what they collected even in the equity shares. We call ULIPs, unit linked insurance premiums. Therefore, insurance company says that you are paying the premium covering the risk plus saving. What is the exactly percentage of saving we unable to say, because the policy is such that it is high risk, high return policy. There may be more than 80%, less than 80%, but we can't promise now. Like that, the premium is collected covering the risk plus savings. Then what is the taxable supply? Law of the land says that if it is first year premium, 25% of that premium we will treat as taxable value of supply. 25%. In the subsequent year and years till the end of the maturity, that premium what you are paying, 12.5%, exactly 50% of 25%, namely 12.5%, 12.5% we will charge, we will treat as taxable supply, on which we charge GST. First year premium 25%, second year onwards the premium multiplied by 12.5% is the value of taxable supply on which you pay GST. If the premium is called as single annuity premium, means the premium is paid only once. Single premium annuity, that means I am a farmer, I sold my cultivated land, I got 2 crores of money, I have 2 daughters, I want to safeguard the money for my daughters education, higher education or marriage expenditure, like that. Therefore, what I did is 50 lakhs premium for my one daughter, 50 lakhs premium for another daughter I paid for 25 years. That means only once I paid the premium, every year I am not going to pay. At the end of the maturity of the premium and the policy, some amount will be returned back to me. It is called as single premium annuity. In that case, the insurance company not able to inform exactly what is the amount going to be paid to me at the end of the policy period. In that case, 10% of such single premium annuity amount is equal to value of taxable supply.